So this video is like a sequel to my yesterday's video. In yesterday's video, I discussed about Genesys International, okay, a computer tech services company, and I rejected the stock. And I gave you reasons as to why I am rejecting the stock. It looked comparatively strong, technically strong, fundamentally strong, okay, not very strong in all the three areas, but I found one weakness in each of the three areas. Moreover, it was not a leading stock. That is why I ended up rejecting the stock. So let me show you the chart when I rejected the stock. Okay. So this is what I saw. If you check my yesterday's video, this is the chart that you see. I have drawn the base here, green, blue, red zone, and that's the buy point. This is what I saw when I was discussing this stock yesterday. Okay. In yesterday's video, I spoke about comparatives, comparative analysis, technical analysis, fundamental analysis, market analysis, and number five, liquidity analysis. Liquidity analysis is something that I introduced for the first time on my channel on yesterday's video. So that is important. Okay. So please watch yesterday's video before you come to this video. The goal of this video is to help you understand the importance of one statement. And that statement is our goal as a professional trader is to buy the right stock at the right price at the right time. Let me repeat that. Our goal as a professional trader is to buy the right stock at the right price at the right time. Okay, so I'm talking about stock selection and trade execution here. As I have said before, you will have to master three skills to become a professional stock trader: stock selection, trade execution, trade management. Out of these three, stock selection is like half the battle won. If you can do proper stock selection, then trade execution and trade management are not a big deal. Okay. Trade management is where trading becomes an art. Uh, and trade execution and stock selection is where trading is more of a science. It's more of a mechanical approach. Okay. So this is the chart that I saw yesterday. And I said, I'm not going to get into this stock. I'm not going to put this stock on my buy alert list. And look what happened today. See, when you reject a stock, you have to go back and see whether the decision that you took was right or wrong. Look what happened today. There was weakness in the market. Now, why was there weakness in the market? Probably it has got nothing to do with the company. It has probably something to do with the new virus that is coming out of China. Okay, so the market was down. And when the general market index, like a Nifty, is down in India, 3 out of 4 stocks are going to be down on that particular day. So that is what happened here. The important point is my buy point is marked here. So even if I had put the stock on my buy alert list, okay, I would have never ended up buying the stock because the stock never touched that price. So you see the importance of having a robust system that keeps you away from a falling stock. So even if I had selected this stock to buy today is 6th of January, okay, even if I had selected the stock to buy today, I would not have ended up buying the stock because the stock from the moment it opened started to show weakness. Now, if I had bought the stock on 3rd of January without waiting for the stock to hit that yellow line, that is called as a premature purchase. Okay, this is what a lot of traders do. If you buy a stock below the yellow line, that's a premature purchase. You are taking huge risk. And see what happens when you take that risk. Okay, the stock is down almost 4% in a single day. And if you buy a stock after it has already crossed the yellow line or that 1% yellow band, you are buying an extended stock. You are buying a stock which is not offering you a low risk entry point. Okay. So please understand that don't buy above the yellow line, don't buy below the yellow line. Below the yellow line is premature purchase. Above the yellow line is extended stock purchase. Okay. So there is a band, there is a 1% band from the yellow line and 1% above. In that range, that is the ideal range to get hold of that stock. Whatever shares you plan to buy, your average execution price must come within that yellow color band. Okay. Yellow color band is nothing but 1% above the yellow line. In that band, you have to complete your purchase. That's a part of trade execution. I'm not discussing trade execution here. My point is to discuss stock selection. Now, if you notice this stock, triple digit EPS growth, triple digit sales growth, 3 years of continuous positive growth in annual EPS. Okay. Margin, I think, is very good. It was negative recently. Margin is very, very good, although it is not at an all-time high. Looks decent. The problem with the stock was it was not a market leader. It doesn't even come in the top 20 when you look at the market capitalization. Okay. And in yesterday's video, I also discussed the definition of what is a leading stock. So yesterday's video is very important. Okay. Technically also it is strong. It is above all the three moving averages. There are blue dots, which means it is doing much better than the Nifty. Okay. In spite of looking at all of these factors, I still ended up rejecting the stock. Why? Because I'm focusing more on the weakness than on the strength. Why? Because of the weak market conditions, right? Market Smith says that the market is in a confirmed uptrend, but my question is that uptrend sustainable? If Market Smith is saying, let me show you. If Market Smith is saying that the market has gone into a confirmed uptrend after 3rd of January, then what is this? Why did this happen? Now the Nifty has closed below all the three moving averages. The blue line has gone below the green line, which means the 50-day has gone below the 150-day simple moving average. So, and if the Nifty undercuts this low and this low, suddenly this state will change into downtrend, right? That's very risky. And I'm sure today a lot of traders must have lost money today because there was news all over the place where the market is forming a nice base and it will start to go up from here in spite of high volume. It did not fall as much. I heard news like that on TV and in the newspapers as well. But that is opinion. I want to look at fact. What is a fact? Fact is Nifty is down 1.62%, which is huge. For traders, this is huge, 1.62%. Okay. Coming back to Genesis. Now, if we look at Genesis, look at how the base has changed now. See, it has undercut point number 2. So now this is point 1, this is point 2. So you have to wait for 2 more points to complete and the market to recover before you even start considering this stock for purchase, which means another 2-3 weeks there you don't have any business looking at this stock. Okay, easily another at least a couple of weeks. If it continues to form the base, if it breaks that blue line, then very less chances that the stock would come up sooner. Okay, so that is my sequel video on Genesis. What I do is when I reject a stock, I go back and check whether my decision was correct or not. Sometimes it is correct, sometimes it is incorrect. But it's important to do this exercise. See, I have not bought anything, right? But it's important to do this exercise so that we get a feel of the market. We get an intuitive feel of the market. I'm sure today when I sit to do analysis of stocks, when I filter stocks, I'm going to get a lesser number of stocks because a lot of stocks are going to be down more than 5% today, right? So that is why today again I made a video to discuss Genesis because the structure of the base has changed. Now, the structure of the base has changed, but is the stock still in a stage 2 confirmed uptrend? The answer is yes, because the price is trading above all the three moving averages and all the three moving averages are sloping up, right? And there is contraction in volume inside the base and there is blue dot inside the base. Okay, so the stage 2 confirmed uptrend status of the stock has not changed. What has changed is the nature of the base. We might have to wait for some time. We have to give the stock some time before we start to reconsider it again. And the buy point has failed. That yellow color buy point has failed. It's called the failure of the pivot point or failure of the buy point. There is a difference between pivot point and buy point, which I will discuss in some other video. But please understand that even if I had put this stock on my buy alert list, I would have never ended up buying the stock because my system is robust. It automatically keeps me away from a falling stock. It doesn't allow me to enter. That is the kind of system we need to develop, and our system needs to be simple. If I sit and read the annual report and balance sheet of every company that comes on my filter, I will suffer a burnout, right? And I don't want to burn out. I just want to do five kinds of analysis: comparative, technical, fundamental, market analysis, and liquidity analysis. And I want to do all of this in less than 10 to 15 seconds, right? I don't want to spend too much time on a stock. Once I get a position in the stock, I might do some research and look at the business and look at the management and look at the products, the clientele of the company, the sector, competitive positioning, things like that. But before that comes this five kind of analysis. Okay. So that is my approach, which I wanted to discuss with you. Just because the stock has taken out point number two doesn't mean that I outright rejected it. When it forms another base, proper base, I will come back to reconsider this stock. Now suddenly the stock wouldn't become a market leader, right? From position 20, it's not going to go to position number 3 or position number 5. But at that time, I will see if I like the base, if I like price tightness, I might take small risk by taking half position size in the stock. So as a professional trader, I am flexible. I'm not outright rejecting a stock. One more thing, a lot of students were asking me, what is the time frame for a swing trade and a positional trade? Let me repeat. As a swing trader, your goal is to make a double digit return in less than 2 to 4 weeks. That's your goal. From your buy point, if you are getting a double digit return in 2 to 4 weeks, that's a swing trade. Okay, that's a defined time frame. But when it comes to positional trading, it is not much about time as much as it is about the 50-day simple moving average. As long as the price remains above the 50-day simple moving average, a positional trader should maintain some position in the stock. World champions, what they do is they buy a stock with a high position size like 20-25% position size. The stock goes up 20-25%. They sell maybe 10% of their position or maybe 15% of their position, and they book their profit, and they retain 10% position size in that stock, and they ride that stock as long as it remains above the 50-day simple moving average. This is what I see champions doing. No champion will hold on to the stock as long as it remains above the 50-day moving average. You would not put 25% of your portfolio in a stock and say that I will stay in the stock as long as it remains above the 50-day simple moving average. The stock could break any time. The stock could collapse 15% in a single day. I have seen that happen in so many stocks. Go and look at stocks like Chennai Petroleum, crashed 15% in a single day. Look at Siemens, crashed 10% in a single day. Motilal Oswal, I think, Divi's Lab created falling window. Okay. So pay attention to the market, pay attention to the price. One more thing I want to tell you before I close the video. People look at indicators. People look at Bollinger Bands, people look at stochastics, MACD, RSI, things like that. These are indicators that people look at. The argument that I want to make to you is price itself is an indicator. See, stochastics, MACD, RSI, these are all derived from price or volume, right? But I am here to tell you that price itself is an indicator. Even before you see a deterioration in earnings, you will see a deterioration in price. So pay attention to the price, because the stock market does not look at the past. The stock market looks into the future. The stock market is like a discounting mechanism. So if there is a EPS deceleration in growth, you will see the stock start to collapse even before poor earnings are reported. So institutional investors are not going to wait for the earnings report to get published. Institutional investors are going to dump the stock before even the earnings report get published, right? So price itself is an indicator of institutional behavior. So if the price itself is an indicator, why would you add another indicator on top of the price? You are complicating the system. That is why you see only some moving averages, and that's it. Moving average, price and volume. There's nothing else on this chart. Do you see anything on this chart? There is nothing else. The base and the line, these are just drawing tools. They are not indicators, right? So please understand that price itself is an indicator. Go and check the chart, weekly chart of Divis. Okay. Divis started falling in October 2021, but the earnings started to fall in October 2022. So 1 year before the earnings started to fall, the price had already started falling. Go and check the chart of divis, you will understand. So please look at price as an indicator. What does this indicate? What does this price indicate? This indicates that there is weakness going forward. So we have to wait. We have to give the stock some time. We can't buy a stock just because it hit the support and it went up and things like that. No, no. This is a stage two stock. Stage two stocks are not supposed to do this. Okay. You look at Siemens. You have to pay attention to what is happening. Look what happened. There was a nice base. There was a buy point here. I did not make a video on this stock. I should have made a video, but I did not buy on that day. On that day, I was analyzing the stock. I did not buy on that day because of multiple reasons. One was the sales growth. Latest quarter was only 11% consolidated. We look for minimum 25%. Very simple criteria. Is nothing complex here. This is not rocket science. I am giving you basic stock selection criteria. Okay. There's one YouTube subscriber who bought a stock recently, which is listed only on the BSC. It is not even listed on the NSC. Okay, so and plus it has got average daily volume as like 25,000, 30,000 shares traded. Big red flag, right? Illiquid stock traded only on the BSC. Very, very simple criteria not to buy these stocks. The stock crashed 10% today. I will not name the stock. The stock crashed 10% today. So make sure you buy a diary. In that diary, write down your stock selection criteria. In that diary, take 5 pages. On the top of each page, write comparative analysis, technical analysis, fundamental analysis, market analysis, and liquidity analysis. Take those 5 pages. Okay. Under comparative, write your criteria. Under technical, write your criteria. Under fundamental, write your criteria. Under market analysis, mention your criteria. Under liquidity, mention your criteria. Carry that diary with you always. Okay, memorize your stock selection criteria so that you don't have to refer to that diary again and again, maybe after 1 or 2 months. This is called hard work. Okay, you have to do hard work. If you want to become a great surgeon, you have to spend time with a great surgeon and you have to study. Okay, if you want to become a great lawyer, you have to spend time with a great lawyer and you have to study. Similarly, if you want to become a professional stock trader, you have to take notes and you have to apply that in the market. Don't waste time doing backtesting. This is already a 100-year backtested system. Okay, if you read William O'Neill's book. So if somebody has already backtested the system, why would you try to reinvent the wheel? Do not reinvent the wheel. Don't waste time in backtesting. Spend time in forward testing. Write down the criteria that I am discussing with you all along on my YouTube channel and check for yourself. Start with a small position size of 5% and see what happens. What is the worst thing that can happen? You will lose money, right? How much can you lose? Like 5% position size, 8% stop loss. You cannot lose more than 0.4% of your portfolio. 0.4% is nothing. Even if you lose 10 trades in a row, you will still maintain 96% of your portfolio. You will still have 96% of your portfolio in cash, right? Even if you lose 10 trades in a row. So take small risk, small position size, apply the concepts that I'm teaching you and learn along the way. Unless you make a mistake, how are you going to learn? I see a lot of students, I call them training junkies. Training junkies, like they buy books, they buy trainings, they buy softwares, they buy tools, everything they will do. But there is one thing that they will not do. They will not put the trade. They will not put the trade. Why? Because they are afraid. They are fearful that they will lose money. If you want to learn how to ride a bicycle, you have to get on the bicycle, right? You will fall, but no problem, right? You can start with a 5% position size. But, anyways, I wanted to discuss with you Genesys today. I spent more time on other things than Genesys. But I just wanted to convey to you that market conditions are weak. So why not stay away? Sit on the fence, wait for the market conditions to recover. Opportunities will come, right? New base formations will come. Then we will see. Mark Minervini, who is a two-time US investing champion in 2021, when he was trading, his portfolio exposure was 0% for 6 months in 2021, and he still ended up becoming the US investing champion. So there is value in waiting. Charlie Munger says, you don't make money when you buy. You don't make money when you sell. You make money when you wait. So please wait. we have to see what happens to the market. Now there is news about some new HMPV virus that is coming from China, and India, some cases are reported. Nobody knows what is going to happen in the future. So let us wait and wait for the market conditions to improve. Till then, we keep screening for stocks, we keep rejecting stocks. Okay, and then we see whether the decision that we took was right or not. Right? Take care.